All right, something just happened in the silver market that almost nobody is talking about correctly. In a matter of days, Western silver prices collapsed from around $121 an ounce to roughly 85. That's a 40% wipeout. Violent. Fast. And while Western investors were dumping contracts, reports just hit that China is now stepping in and buying billions of dollars worth of gold and silver at these levels. Here's the wild part. Spot silver in the West is near 85, but Shanghai silver is still trading around 122. That price split just confirmed something huge. If you're holding silver right now, if you're watching this market, or if you're trying to figure out what just happened, stay with me, because I'm going to show you why this matters right now and how you can spot this exact pattern the next time it shows up in any market. Before I explain what caused this crash, let me teach you something most people don't understand about how metals actually trade. You don't have one silver market, you have two. You've got the paper market where futures contracts trade at massive leverage, and you've got the physical market where real metal changes hands. Most of the time they move together, so people assume they're the same thing. They're not. And that assumption costs people a lot of money when things get volatile. Think of it like airline tickets versus actual seats on the plane. You can trade tickets all day long. You can flip them, resell them, cancel them. But when everyone tries to board at once, only the physical seats matter. That distinction becomes absolutely critical during periods of stress. When leverage unwinds, paper prices can collapse even if nobody stopped wanting the actual metal. That's not a theory. That's what we're watching right now. So when you see silver drop 40% in Western markets, but Shanghai prices barely move, you're not looking at demand destruction. You're looking at a structural break between paper contracts and physical reality. And when you understand that difference, you can read what's happening instead of just reacting to the price action. So, what does that tell us? It tells us that the price you're seeing on your screen might not actually reflect what's happening in the real world. It tells us that forced selling creates opportunities for those who understand the mechanics. And it tells us that when these two markets diverge this much, something has to give. Now, here's what's actually happening. Let me break down the sequence because the order matters. First, silver had been bid aggressively in Western futures markets over the past few weeks. Lots of leverage, lots of margin, traders piling in. When prices started slipping, margin calls kicked in. And here's where it gets mechanical. Traders didn't sell because they wanted to. They sold because they had to. That forced selling pushed prices lower, which triggered more margin calls, which forced more selling. That's the cascade. This is what deleveraging looks like in real time. This wasn't a demand collapse. This was a balance sheet collapse. People weren't selling because they thought silver was worthless. They were selling because their brokers were making them. Now here's the confirmation, and this is critical. While Western spot prices fell to 85, Shanghai silver barely budged, holding near 122. That tells you physical demand never disappeared. It tells you that people who actually want the metal, who need the metal, who are buying it to hold it, didn't change their minds. They're still there. They're still bidding. And when you see a 40% premium for physical metal in one market versus paper prices in another, that's the market screaming that something is broken. That's not normal. That's not sustainable. That's a dislocation. Here's what makes this even more interesting. China watches these dislocations like a hawk. When Western paper markets puke, when forced selling drives prices down artificially, China steps in and converts that paper weakness into physical metal. They've done it before, they're doing it again. Reports are coming out right now that Chinese buyers are accumulating billions of dollars worth of gold and silver at these depressed Western prices. They're buying real silver at a discount created by forced liquidation elsewhere. And here's the part most people are missing. That price gap, that premium, it only exists when selling is mechanical, not fundamental. When selling is forced by margin calls and deleveraging, prices can disconnect from reality. But when that forced selling exhausts, when the liquidation runs its course, prices tend to snap back. Hard. But here's the part that should make you nervous if you're not paying attention. If forced selling exhausts and the physical market stays bid, the snapback can be just as violent as the crash. We've seen this movie before. The setup is always the same. Leverage unwinds, paper sells off, physical stays firm, strong hands accumulate, and then when the dust settles, prices reconnect with physical reality. Sometimes that happens in days. Sometimes it takes weeks. But the pattern is consistent. Now let me show you what very few people are talking about. This isn't new. This is the exact same playbook we saw in 2008. During the financial crisis, silver collapsed on paper as hedge funds and leveraged traders deleveraged everything. Silver went from around $20 down to under $9 in a matter of months. Brutal sell off. But while paper prices were cratering, physical demand stayed strong. Premiums on coins and bars exploded. You couldn't find physical silver anywhere, and what was China doing? They were accumulating. Quietly, methodically. Prices rebounded hard. Once forced selling ended, silver went from under $9 to nearly $50 over the next 3 years. Same pattern. Same thing in 2020. Remember March 2020? The liquidity panic when everything sold off? Silver crashed from around $18 down to $12 in a matter of days. Stocks were crashing, bonds were selling, even gold dropped. Everything was being sold to raise cash. But what happened in the physical silver market? Premiums exploded. Dealers were charging $5, $6, $7 over spot just to get coins. The US Mint couldn't keep up with demand. And within months, by August of that same year, silver had doubled to over $28. Why? Because the forced selling stopped. Because physical demand never went away. Because the dislocation corrected. When you zoom out, the pattern is consistent across multiple cycles. Paper stress creates fake weakness. Strong hands step in quietly while everyone else is panicking. Volatility shakes out weak holders who are over-leveraged or emotionally unstable. And then price reconnects with physical reality. The larger story here is that silver doesn't need perfect conditions to rally. It doesn't need inflation to spike. It doesn't need the dollar to collapse. It just needs selling pressure to stop. That's it. When mechanical selling exhausts, the physical bid shows up. Now, before we go further, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this stay ugly? Absolutely. Could prices overshoot to the downside and go even lower than 85? Yes. Markets overshoot all the time. Could volatility wreck anyone who's over-leveraged or using too much margin? 100%. That's exactly what's happening right now to some traders. And no, this doesn't mean every crash is manipulated or that some evil cartel is suppressing prices. Markets can be irrational. Markets can be mechanical. And markets can stay broken longer than you expect. Here's the thing. It doesn't actually matter whether this was intentional manipulation or just natural deleveraging. The mechanics are what matter. What you can measure, what you can observe, what you can verify. Is there a premium in Shanghai? Yes. Is Western silver trading at a discount? Yes. Is China reportedly buying? Yes. Those are facts. Everything else is speculation. So focus on what you can control. Focus on signals. Focus on structure. Focus on what the market is actually telling you, not what you hope it will do. Don't confuse your position with your analysis. If you're bullish, you want prices to go up. I get it. But that doesn't mean they will. Read the market. Don't project onto it. Now, there are probably 3 types of people watching this right now. First, you might be underwater. You might be staring at losses right now, wondering if you messed up, wondering if you should sell, wondering if this thing is going to zero. If that's you, breathe. The worst thing you can do is make emotional decisions during mechanical events. Your job isn't to be a hero. Your job is survival. If you're holding physical metal, you haven't lost anything unless you sell. If you're holding leveraged positions, you need to assess your risk honestly. Can you survive more downside? If the answer is no, you might need to reduce position size. There's no shame in that. Preservation of capital is the first rule. But if you can hold through volatility, if you're not forced to sell, then understand what you're seeing. This is forced selling, creating opportunity, not fundamental weakness. Second, you might be flat right now. You might be watching from the sidelines, sitting in cash, unsure if this is opportunity or a trap. That's fair. That's actually a smart position if you're uncertain. For you, patience is a position. You don't have to do anything. Let the market prove itself. Let the signals confirm. If physical premiums stay elevated, if Shanghai stays firm, if Western prices stabilize, then you'll have your answer. You might miss the absolute bottom. That's okay. Nobody catches the exact bottom anyway. What matters is that you enter with confirmation, with a plan, with defined risk. Wait for your setup. Third, you might be experienced. You might be looking at this and seeing asymmetric setups. You might be someone who's traded through multiple cycles and you understand that chaos creates opportunity. If that's you, you already know this isn't about catching a bottom. It's about watching confirmation signals and sizing risk intelligently. You know that the best opportunities come when everyone else is panicking. You know that when physical and paper diverge this much, there's usually money to be made on the convergence. But you also know that timing matters. You're not going all in, you're scaling, you're testing, you're managing risk. No matter which one you are, the universal principle is the same. Don't confuse forced selling with fundamental weakness. When prices drop because of margin calls, because of deleveraging, because of technical factors, that's different than prices dropping because demand disappeared. And right now, the evidence suggests demand didn't disappear. The premium in Shanghai proves that. The reports of Chinese buying prove that. The physical market staying firm proves that. So here's what I want you to answer in the comments. Are you watching this as an opportunity, or are you concerned about more downside? What's your read on this price action? I'm genuinely curious where people's heads are at right now because sentiment matters. When everyone's scared, that's usually when opportunities emerge. When everyone's euphoric, that's usually when risk is highest. So drop a comment. Let me know what you're thinking. Here's where I stand personally. I'm not euphoric and I'm not panicking. I'm watching. Let me tell you what I'm personally watching. First, I'm watching whether 80 to 85 holds in Western markets. If we break below 80 and start cascading lower, that would indicate more forced selling needs to happen. That would tell me the deleveraging isn't done. But if we hold above 80, if we start building a base here, that would suggest selling pressure is exhausting. Second, I'm watching whether Shanghai silver stays above 115. If Shanghai drops below 115, that would tell me physical demand is weakening. But if it holds, if it stays firm, that tells me the physical market is intact. Third, I'm monitoring the premium between the two markets. If that premium stays above 25%, the recovery scenario stays very much alive into next week. If the premium starts collapsing, if Shanghai and Western prices start converging downward, then we've got a different situation. Based on my analysis, this crash was mechanical, not emotional. This was forced selling, driven by leverage and margin calls, not fundamental deterioration. The fundamental picture around silver hasn't changed. Industrial demand is still strong. Solar panels still need silver. Electronics still need silver. Green energy transition still needs silver. Supply is still constrained. Mining production isn't ramping significantly. Recycling can only provide so much. The physical market dynamics that made silver interesting a month ago are still in place today. What changed was the leverage structure in Western futures markets. And when leverage unwinds, it creates volatility. But volatility isn't the same as value destruction. If history rhymes, and I think it often does, and if silver holds these levels and confirms that the selling pressure is done, the move that follows could be significant. I'm not making a price prediction. I'm not telling you silver's going to 150 or 200. I don't know. Nobody knows. But I do know that when physical and paper markets diverge this much, when you've got a 40% premium in one market versus another, that dislocation typically resolves. And historically, it's resolved higher more often than lower. That doesn't mean it has to, that doesn't mean it will, but that's what the pattern suggests. I'm not a financial advisor. This is not financial advice. I'm sharing my analysis, my read on what's happening, the signals I'm watching. You need to do your own research. You need to make your own decisions based on your own risk tolerance, your own time horizon, your own financial situation. Don't trade with money you can't afford to lose. Don't use leverage you can't handle. And don't make decisions based on emotion or fear of missing out. If you made it this far, you're thinking critically. You're not just reacting to headlines. You're not panicking when prices drop or getting euphoric when they spike. That mentality, that discipline, will serve you well in markets because markets are cyclical. They move in waves, and the people who survive long term are the ones who can read the waves without getting swept away by them. If this analysis helped you understand what's happening, hit that subscribe button. Share this with someone who's trying to make sense of this volatility. And stay ahead of the narrative because the mainstream explanation you're going to hear is probably going to be incomplete. They're going to say silver crashed because demand fell. They're not going to explain the leverage structure. They're not going to talk about the premium in Shanghai. They're not going to mention that China's buying. But now you know. Now you can see the difference between paper prices and physical reality. Now you can recognize this pattern when it shows up in other markets, because it will. Stay sharp out there. Verify the data, think critically, and make your own decisions.